Go.
Good morning, my name is Olusayo Okasaga, and I'm here with my group, and we're going to be doing the DuPont analysis for Apple and Samsung. I'm going to take you through how this video is going to go, and then we're going to go right into it.
Yes.
The purpose of this report is to do a DuPont analysis of the companies, Samsung and Apple. In the report, we evaluate the companies on the trends of its financial ratios over time and evaluate them against industry standards. We're going to showcase these results with the following ratios. Current ratios, quick ratio, cash ratio, day sales outstanding, inventory turnover, production cycle, accounts receivable turnover, average collection cycle, accounts payable turnover, average payment cycle, cash conversion cycle, sales to working capital, capital intensity, total asset turnover, debt ratio, cash coverage, equity ratio, debt to equity, leverage ratio, times interest earned, total profit margin, operating profit margin, net profit margin, operating income return on assets, return on total assets, return on common equity, equity multiplier, equity multiplier, price earnings to growth, market value to book value, dividend payout, retention ratio, dividend yield ratio, and growth rate. For this project, we used several resources to find information on both companies. This enabled us to find all ratios and compare them against each other. Without further ado, we're going to go right in.
I am Joseph Tucker. I'm starting off with accounts payable turnover. Accounts payable turnover is a ratio that measures the speed with which a company pays its suppliers. If the turnover ratio declines from one period to the next, this indicates that the company is paying its suppliers slower and may be an indicator of worsening financial conditions. The formula is the total supplier purchases divided by the beginning accounts payable plus the ending accounts payable. Apple's accounts payable never fluctuated under 3%. It stayed in an average between 3 and 4%. Samsung, on the other hand, averaged between 20% and 31%, being the highest in 2016. Accounts receivable turnover is the number of times per year that a business collects its average accounts receivable. The ratio is intended to evaluate the ability of a company to efficiently issue credit to its customers and collect funds from them in a timely manner. A high turnover ratio indicates a combination of a conservative credit policy and an aggressive collections department, as well as a number of high-quality customers. A low turnover ratio represents an opportunity to collect excessively old accounts receivable that are unnecessarily tying up working capital. The formula, net annual credit sales divided beginning accounts receivable plus ending accounts receivable divided by 2. The Apple ratio stayed in between 19% and declined all the way to 11% in 2014. In 2017, they came back up to an 18% percentile. On the other hand, Samsung stayed their average stayed very consistent, starting in 2012 at a 7.9 percentage and ending in 2016 at an 8.1 percentile. They didn't fluctuate very much from the 7.9 to the 2 and ending of 8.1%. Accounts collection cycle. The accounts collection period is the average number of days between the date that a credit sale is made and the date that the money is received from a customer. So you take the average accounts receivable divided by account credit sales and then multiply it by the days in the period. Apple's average collection cycle started in 2011 at 18% and in 2016 ended at a 27 percentile. In 2014, it spiked all the way up to a 35 percentile. On the other hand, Samsung stayed very consistent through 2012 to 2016, with starting at 46% and ending at 44%. Average payment cycle, days payable outstanding, is a company's average payable period that measures how long it takes a company to pay its invoice from trade creditors, such as suppliers. So the formula consists of ending accounts payable divided by cost of sales divided by number of days. Apple average payment started in 2011 at 83%, and it ended at 104% in 2016. It fluctuated in 2013 to 77% and ended at a high of 104%. Samsung started very low at a 5.2 percentile and then rose up all the way to a 16% in 2016. Capital intensity is a firm's efficiency in deployment of its assets, computed as a ratio of the total value of assets to sales revenue generated over a given period. Capital intensity indicates how much money is invested to produce $1 of sales revenue. So you take the total sales and divide it by sales revenue. Apple was very consistent with sales revenue. It started at a 16% in 2011 and spiked up in 2016 to 29.6%. In 2015, though, it raised from, in 2014, it decreased from 24.84% to 21.52% in 2015 and spiked all the way up to 29.65% in 2016. Samsung started in 2011 at a 13%. They spiked up to 18.5% in 2012, kept rising in 2013 to 20%, and by 2015 declined all the way to 9.75%. Cash conversion cycle measures the length of time in days that it takes for a company to convert resource inputs into cash flow. The cash conversion cycle attempts to measure the amount of time each net input dollar is tied up in the production and sales process before it's converted into cash through sales to customers. You take the days inventory outstanding plus the days sales outstanding and you minus the days payable outstanding. Apple's cash conversion cycle started in the negative 61 percentile and has decreased since to a negative 71 percentile in 2016. On the other hand, Samsung has been at a positive 43 percentile and risen to an 81 percentile in 2016. Production cycle is a period in which inventories are being turned by the company into finished goods. For a company, that decrease of the production cycle is desirable. This means that the company is decreasing the amount of time needed for turning its average inventories into finished goods. Short operation cycle allows to decrease the share of fixed expenses in each dollar of manufacturing goods and provided services. The formula consists of number of days times the average inventories divided by the cost of goods sold. Apple's production cycle started at 22% in 2011 and risen all the way up to 42% in 2014. It declined in 2015 to 32% and stayed consistent to 2016 at 33%. Samsung in 2012 has stayed very consistent at a 47.56 percentile, leading to 2016 at a 55.64% percentile. Quick ratio is an analysis used to examine the ability of a business to pay its debts. The quick ratio is based on assets and liabilities of a company's balance sheet. The formula consists of cash plus marketable securities plus accounts receivable. You add that total and divide it by the accounts payable. The exact content of a ratio can vary, depending on the types of assets and liabilities that a company holds. The main point of constructing the ratio in this manner is to avoid the liquid assets, which means inventory and fixed assets. By doing so, we arrive at a ratio of essentially the cash that should be available in the short term to the cash requirements of a business in the short term.
Hi, my name is Darnay Honeycutt, and I will be starting off with cash ratio. The cash ratio compares a company's most liquid assets to the current liability. The ratio is used to determine whether a business can meet its short-term obligation. The formula they use is cash plus cash equivalent divided by current liability. Apple started off in 2012 at 7,600, and Samsung started off at 8,000. Samsung started off at 0.8000 in 2012, and then Apple started at 0.7600 in 2012. Samsung stayed consistent all the way to 2016 at 1.6100. Apple went up and down at 0.7400 in 2016. The current ratio measures the ability of organization to pay the bills in the near term. It is a common measure of short-term liquidity of a business. The ratio is used to determine whether you should invest or lend in money to intended. The formula they use is current assets divided by current liability. Days sales outstanding. The days sales outstanding is the average numbers of days that the receivable remain outstanding before they are collected. The measurable is usually applied to the entire set of invoices the company has outstanding at any point in time, rather than a single invoice. The point of days sales outstanding is determined the effectiveness of a company credit and collection effort in allowing credit to repay customers, as well as ability to collect from them. The formula they use is account receivable divided by annual revenue times the number of days. Apple started off in 2011 at 18.34. Samsung started in 46.130 in 2012. Apple went up and down up until 19.69 in 2016. Samsung stayed consistent all the way through to 44.700. Debt ratio. The debt ratio is a comparative company total debt and total assets. The providers, credit, and investors with a general idea as the amount of leverage being used by the company. The lower the percentage, the less a company is using, and the stronger its liquidity. The higher the ratio, the more risk the company is considered to have taken on. The formula they use is total liability divided by total assets. With Apple, they started off at 34.16. By 2014, they was up at 51.89. And by 2016, it was up at 60.13. On the other hand, Samsung started at 37.60, went down by 2014 at 29.620, and by 2016, they consisted to 28.890. Debt to equity. Debt to equity ratio measures the risk of a company financial structure. The ratio reveals the relative proportion of debt and equity financing the business employee. It can provide early warning that an organization is so overwhelmed by the debt that it is unable to meet its payment obligation. When a business has a debt to equity ratio, it has imposed on its large block of fixed costs in the form of interest expense, which is decreasing the breaking even point. This means it takes more sales from the firm to earn a profit. And to find that, they use the formula long-term debt plus short-term debt plus lease divided by equity. Samsung started at 0.05 in 2011, and then they did a decrease at 0.00, and then stayed consistent, only went up to 0.10 by 2016. Apple, on the other hand, has started increase from 0.14 in 2013 and stayed all the way consistent in 2016 at 0.5900. Dividend payout. The dividend payout ratio measures the proportion of any payout to shareholders as the dividend. The ratio is used to determine the ability of equity to pay dividends, as well as the reliability in doing so. As a company is paying in mature interest or whose sales are no attractive, who buy and sell almost exclusive of relative of dividend payment. Growth investors do not invest in these companies. And to find the dividend payout, they have used total dividend paid divided by net income. In 2012, Apple started at 0.380. They did an increase by 2013 at 1.630, and it stayed is consistent all the way to 2015 by 14.70. Samsung started at 5.20, did a decrease at 2013 at 3.80, and then did an increase at 1.980 by 2016. Net profit margin. The net profit margin is the percentage of revenues left after all the expenses have been deducted from the sales. The measurement reveals the amount of profit that a business can extract from its total sales. The net sales of this equation is gross sale minus all the sales deductions, such as sales allowance. A high net profit margin indicates that a business is pricing its product correctly and is exercising good cost control. And they found that by dividing net profit by net sales times 100. In 2011, Apple started off with 23.950. They went up and down all the way to 2016 until 21.90. Samsung started off at 11.530 in 2012. They went up and down as well all the way to 2016 at 11.10. Operating income return on assets. The return on operating assets measurement focus attention on only those assets used to generate revenue. Once a measured, a common outcome is the manager work to minimize all the other assets on the book that are not contributing to the revenue. And to find that, they did net income divided by assets used to create revenue. In 2011, Apple started off with 41.04. They went down all the way to 2016 to 21.95. Samsung started at 18.55 in 2012 and went all the way down to 10.98 by 2016. Cash coverage. Cash coverage is the useful to determine the amount of cash available to pay for a borrower interest expense, and is expressed as the ratio of the cash available to the amount interest to be paid. To show sufficient ability to pay, the ratio should be greater than 1.1. And they found that by doing earning before interest and taxes plus non-cash expense divided by interest expense. In 2011, Apple started off at 27.64. By the time they got to 2016, it was 88.50. In 2014, Samsung was 48.01, and they decreased all the way to 28.6 by 2017.
Hi, my name is Eddie McNeil, and I'm going to start with operating profit margin. Operating profit margin is the profit that a business earns from its operating activities. It reveals the financial viability of the core operations of the business before any extraneous financial or tax-related effects. The expenses included in the calculation of the operating profit margin are comprised of both variable expenses and fixed expenses. The company's operating profit margin often determines how well the company can satisfy creditors and create value for shareholders by generating operating cash flow. A healthy operating margin is also required for a company to be able to pay for its fixed costs. So a high margin means that a company has less financial risk than a company with a low margin. Formula is operating income divided by net sale. For 2011, Apple's operating profit margin was 31.2%, rose to 35.3% in 2012, declined to 28.7% in 2013, stayed even at 28.7% in 2014, rose to 30.5% in 2015, and declined to 27.8% in 2016. Samsung's operating profit margin in 2012 was 14.44%, rose to 16.08% in 2013, declined to 12.14% in 2014, increased to 13.16% in 2015, and increased to 14.49% in 2016. Retention ratio. Retention ratio is the proportion of the net income retained to fund the operations of a company. When there is a high calculated retention ratio, management believes that there are uses for cash internally that can yield a rate higher return than the cost of capital. However, if the funds are being returned for no good reason, an investor may earn a negative return on funds. Formula is net income minus dividends paid divided by the net income. In 2012, Apple's retention ratio was at 5.2%, declined to 3.8% in 2013, and by 2016 was at 16%. Samsung was at 27% in 2013, and by 2016 it declined to 24.8%. Return on common equity. Return on common equity is the calculation of the amount of net profits that could potentially be payable to common stockholders. This is used by shareholders to examine the number of dividends they could accumulate from a business. This also calculates how well management is on creating returns with equity they have. The formula is net profits minus dividends on preferred stock divided by the equity minus the preferred stock. Apple's return on common equity for 2011 was at 15.03%. By 2013, it rose to 22.83% and had a steep decline by 2015 to 11.16%. Samsung for 2011 was at 41.67%, had a decline by 2013 to 30.64%, and by 2015 they increased to 46.25%. The return on total asset. Return on total asset is the ratio that measures how much a company earned before interest and taxes over the total net asset. From this ratio, a company can see how effectively a company is using their assets to earn money before having to pay a debt. The formula is earnings before interest and taxes divided by the total net assets. The return on total assets in 2011 for Apple was at 27.07%. By 2013, it declined to 19.34%. And by 2017, it has declined to 13.65%. Samsung in 2012 started at 13.77%, declined to 10.39% by 2014, and by 2016 was at 8.86%. Sales to working capital. Sales to working capital is also known as working capital turnover, which is used to determine the relationship between the money that funds the operations and the sales that came from investing in the operations. Working turnover capital is found by the sales of the company divided by the working capital. To solve for working capital, a company uses its current assets minus current liabilities. The formula is the sales divided by the working capital times the current assets minus the current liabilities. For 2011, the sales to working capital for Apple was at 6.36%. By 2014, it rose to 35.96%. And by 2016, it was at 7.74%. In 2012, for Samsung, their sales to working capital was at negative 5.374%, increased to negative 1.24%, and by 2016 it was at negative 9.98%. Time interest earned, also known as the interest coverage ratio, is used as a way to measure how well a company is meeting or keeping up with their payments of debt. The way TIE is calculated is by taking the company's earnings before interest and taxes and dividing it by the total interest payable on bonds and other debts. Companies that has a low ratio means that the company is struggling to pay its debts and could potentially have to file for bankruptcy if they do not keep up with payments. A high ratio means that the company is handling the debt, which is something bondholders like to see. However, a high ratio is not always a good thing. It can also mean that a company is using too much of its earnings to pay its debts when they could be using the money to invest in other things the company needs to grow. The formula is earnings before interest and taxes divided by the interest payable to debt. 2012, Apple's time interest earned was at 108.8%, declined to 48.01% by 2014, and by 2016 was at 88.5%. Samsung started 2013 at 121.14%, declined to 48%. Oh, I scratched it. I read it wrong. But Apple's time interest earned was at 108% in 2012. By 2014, they were at 48.01%, and by 2016, they were at 43.2%. Samsung in 2013 was at 369.8%, declined to 140.3%, and by 2016 was at 88.50%. Total asset turnover. Asset turnover ratio is a way to keep company measures the values of sales or revenue on an annual basis. The asset turnover ratio can be used to show how efficient a company is at using its assets to generate revenue. The way asset turnover is calculated is by taking sales and dividing by average total assets. The higher the asset turnover is the better the company is performing. The company is making more revenue per dollar of assets. The formula is sales divided by average total assets. In 2011, Apple's average total asset turnover was at 1.13%, and by 2017, they were at 0.69%. Total profit margin. Profit margin is calculated by taking the net income divided by the revenue, or net profits, and divided by the sales. Profit margins are expressed as a percentage. Profit margin measures how much per dollar of sales a company is actually earning. For example, in the graph above is Apple and Samsung's total profit margin from 2011 to 2016. In 2012, Apple had a profit margin of 26.67%, meaning it made 26 cents per dollar they made. In 2012, Samsung made 37.02%, meaning they made 30 cents per dollar made. The formula is the net income divided by the net sales times the revenue. Thank you.
Good morning, everybody. My name is Daniela Guzman, and I am going to continue on with some more ratios. I'm going to continue with leverage ratio. Leverage ratio measures how much capital comes in the form of debt or assets, the ability of a company to meet its financial obligations. A leverage ratio can be used to measure a company's mix of operating expenses to get an idea of how change in output will affect operating income. And so the formula to get leverage ratio is total debt divided by total equity. If you look at the graph, in 2011, Samsung had a leverage ratio of 1.6% and Apple had only 1.5%. Continuing a few years later on, Samsung had 1.4% and Apple increased to 2.5% in 2016. Now, dividend yield ratio. Dividend yield ratio shows the amount of dividends that a company pays to its investors in comparison to the market price of its stocks. If we continue on to 2016, Samsung's equity ratio decreased to 39.87%, and Apple's increased to 71.1%. Now growth rate. Growth rate represents the compounded annual rate of growth of a company's revenue, earned, and dividends. The percent of change from one period to another. So the formula to get growth rate is present or future value minus past or present value divided by past or present value times 100. And so in 2011, Samsung had negative 1.79% and Apple had 11.8%. Continuing on to 2016, Samsung had negative 19% and Apple went down to 18.28%. Now we're going to look at inventory turnover. Inventory turnover measures the rate at which inventory is used over a period of time. It can describe if a business has an excessive inventory investment in comparison to its sales levels, which can indicate either unexpectedly low sales or poor inventory planning. When there is a low rate of inventory turnover, it implies that a business may have a flawed purchasing system that bought too many goods, or that stock was increased in anticipation of sales that did not occur. In both cases, there is a high risk of inventory aging, in which case it becomes obsolete and has little residual value. When there is a high rate of inventory turnover, this implies that the purchasing functions is tightly managed. So the formula to get inventory turnover is annual cost of goods sold divided by inventory turnover. And so if we look at the graph in 2012, the inventory turnover for Samsung was 12.12%, and Apple's inventory turnover was 7.5%. And we continue on to year 2016, and Samsung's inventory turnover rate decreased to 6.4%, and Apple's turnover rate also decreased to 58.64%. Now we have market value to book value. Market value to book value measures the proportion of the current market price of a share of a company's common stock to the book value or share of the company. Market to book value tells whether investors in general value the company above or below the face value of the company's assets. So to calculate market value to book value, we used current share price divided by book value share price. And so if we look at the graph, in 2012, Samsung had 1.14% and Samsung had 4.7%. Continuing on in 2016, Samsung's market to book value increased to 1.27% and Apple's also increased to 4.8%. Okay, so now we have the price earnings to growth, the value or income to development, or price earnings to growth. Proportion is an exceptionally helpful stock valuation measure financial specialists and examiners can use to get more extensive evaluation of an organization's execution and potential, the cost of profit or PE proportion. So how to calculate price earnings to growth? You get price earnings ratio divided by earnings growth ratio. And so if you look in 2012, Samsung had 73% and Apple only had 0.5%. If we go and look at 2014, Samsung decreased dramatically and went to negative 22.6%, and Apple stayed pretty consistent and went to 0.59%. Lastly, we have price earnings. The price earning ratio is the proportion for estimating an organization's that measure its present offer value which represents with respect to its per share profit. The value income proportion is likewise how and again known as the price multiple or the earning multiple. The formula to get price earnings is price per share divided by earnings per share. And so if you look at the graph, in 2013, Samsung had 6.9%, and and Apple had 12.7%. Samsung increased over the years, and by 2016 they had 11.42%, and Apple decreased, and in 2016 they had 13.4%. And so that is it for the ratio.